Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The Silicon Valley Bank turmoil continues to grab the market's attention during the weekend as analysts all across the world deciphered the financials and provided their expert opinion as to why the bank failed. Yesterday night, there was more relief to account holders as Treasury, Fed, and FDIC introduced measures which would provide account holders more withdrawal capacity than the insured $250,000. This can probably be to avoid a bank run scenario and keep the confidence in the banking system. JK, good morning. I'm sure your weekend was filled with deciphering what's happening in the US. Tell us your thoughts.
Good morning, Swaraj. Yes, it's a kind of evolving situation and things are moving, but they are moving very fast. So we had one bank failure, that was Silicon Valley Bank, and then later there was one more bank in the New York, which was shut by the New York Fed, a smaller bank, and they have also assured the depositors that they will get their money paid right from Monday itself. Swift action that they have taken. Actually, Friday, all attention was on non-farm payroll report, and that came higher than expected in terms of the jobs created. But the relief to Fed and probably the market also was that the wage inflation was coming down, and unemployment rate inched up from 3.4 to 3.6%, and that itself started the yields rolling down, and dollar also coming off. But I think the decision to shut down the SVB bank came, overshadowed all that news, and then we saw the risk assets, mainly the stocks, getting sold off, and the yields coming off even bigger way, because fears arose about whether it will affect the whole banking system and whether there will be a systemic issue, etc. As of now, the Fed and the government have taken swift action to ensure that depositors' money is, assured. And they are also assuring that they will be creating a fund to backstop any such bank problems that will require funding. So they've actually taken a preemptive step to arrest any further fallout immediately. No wonder markets will have those fears going forward. And right now it is confined to smaller banks, although these interest rates spiraling move on the upside in the last 1 year wouldn't have spared any book, be it in any country, and everybody would be having a mismatch. It's only the extent to which they would have covered themselves is what matters. And as we were also discussing in another forum, the bank deposit rates might have to go up to ensure that depositors stay with the bank and banks continue to have funding continue, so that the Fed or the government need not come to their rescue. So as of now, the steps taken by the government and the Fed are calming down the markets. Yields are coming down. Now, what is the implication on the monetary policy? We have inflation number tomorrow, where expectation of year-on-year number is at 6% versus 6.4%. And that will be a key number to watch, definitely. Fed is definitely in a dilemma, because if they hike rates aggressively now, it will put system under more stress. If they do not hike and the inflation stays high, there is a risk of stagflation in the US. So this is something that they will have to handle very carefully. But I think top on their minds would be to see that there is no contagion impact or the systemic failure that would be, leave the economy in much deeper trouble. But possibly, the way I see it, I think this can slow down. Already we are seeing some impact on the employment situation, unemployment rate going up, and wage inflation coming down. And we have seen the Challenger jobs report last week showing nearly 80,000 job cuts, adding to it 1 lakh job cuts in January. This is one of the highest job cuts that we have seen. So definitely the biggest concern of Fed on the employment being strong and leading to higher demand started to show some correction, and that probably gives some breathing space for Fed. Markets already down to discounting only 0.25% hike by the Fed, and it seems swinging so much that their terminal rate is now back below 5.5%, and they are even expecting a cut in the rate by the end of this year. But that noise should be ignored. We should go by hard facts. We should go by the inflation number and what the dot plot indicates in the coming forward. Also, we have retail sales number, which will indicate the consumption pattern that is going on in the US economy. So all in all, we are watching how situation evolves, and so long as the systemic issue is avoided, we should be okay with the situation. And overall, dollar, which had a good correction on the upside, probably has ended that correction, but we still need to watch if there is more stress or sell-off in the risk assets, a bigger sell-off, then we may see another bout of strength in the dollar. But looks like having moved up from 100.80 to 105.8, dollar might have seen good correction, and the underlying trend of the dollar being down can resume if things settle down and if the yields stay at these lower levels. It's clearly depicted in the moves in the dollar yen, which has moved nearly 1.5 to 2% in from the highs, and Swiss franc and gold have also benefited. Clearly a depiction of dollar weakness emerging. So far, we have not seen any major dollar demand as a safe haven after this situation. Where does it leave the rupee? I think rupee has been immune to most of the global events in the last few weeks, and it does look like it's not going to impact much, because yes, stocks have got sold up in India as well. I think we have been moving in a range, and that is not really had any impact on the rupee moves so far. We are more glued onto the domestic situation, where we will have clue on the inflation month. This month, or rather on the February number, is likely to slightly moderate by around 20 basis points. And we also have the trade number, which will be published tomorrow, where expectation is for around 20 billion from 17.75 billion. So we'll go by global domestic factors, and also of course the seasonal factors, which sees good supply of dollars from exporters, as well as people who are looking to send money before the year end. So that gives some support to the rupee. Do not see it breaking out of the 81.60 and 82.30 range for now. And that's it. We will keep watching the ongoing situation and keep you updating on that.
Thank you, JK. And as JK covered on the macro side on Friday, we definitely had the non-farm payroll, which came in higher than expected, but there was a cool down in wage inflation, and even the unemployment rate went up. So I think if the SVB situation had not happened, I think markets would have been keenly looking at that. However, the banking situation did grab the limelight. Now I think the focus will be on US regulators creating measures to ensure there is no bank run and people have confidence in the banking system. But it also creates like a dilemma for Fed, because if it hikes aggressively, it will create the same pressure on banks. But if it doesn't hike, there could be a possible stagflationary situation. So it's so time will tell how they navigate this entire situation. And because of all of this, there is a lot of noise in the market expectations of terminal rates, because if you remember, before all of this, we had a sustained move up in what the market was expecting as the terminal rate, but now there is also expectation of rate cuts. So again, so a lot of noise in this front. For domestic rupee, however, we have been immune to most of the global events, and looks like it will be range bound. So as the banking development unfolds, it can create bursts of volatility. Keep managing your risk. That's it from us today. Thank you so much for listening.